In this video, I'm going to make the case that the financialization of the economy, that is, the expanding role of institutional investors with massive portfolios, diverse among industries, has created a situation where businesses are growing less well served by aiming at maximizing profit and are instead rapidly being incentivized to fill out roles inside of what is functionally a production for use economy emerging out of a decaying production for exchange economy. To make this point, I will start with why, on an institutional level, businesses pursue profit and then move on from there. Businesses pursue profit because profit means gaining access to money capital, and money capital means having the ability to purchase resources needed for a business to adapt and grow in an unpredictable environment, whether that means being able to suck up losses or invest in hiring new people and buying new equipment. It is here where you can see why businesses might choose to focus on maximizing profit in the short term. Now, let's move on to how finance allows businesses to focus on longer-term profit. The effect of financialization that everyone is familiar with to some extent, even if they don't really think much about it. Profits aren't the only way a business can get access to money capital. The business might, for example, receive a loan from a bank. Here, the idea is that the business will use the money capital provided for it in the present to run its operations so that they can afford to pay the same plus interest back to its creditors in the future while receiving more money in total than they would have otherwise had without that loan. So this is a straightforward example of a business sacrificing short-term profit maximization in the name of long-term maximization. So with that, we pushed profit maximization into the future. Now what follows leads us to pushing it into the never. It starts with adding on a third source of capital, the investor, specifically the investor in a publicly traded corporation. At first glance, the investor's incentives seem much like the creditor. They put money in now in the expectation of future return, but their incentives are actually very different. The creditor has an expectation of X return at Y time, and their interest in the firm's operations are essentially limited to fulfilling that promise. The investor has no such concrete promise, and as owners of the firm, they are deeply tied to its operation, perhaps directly through having the ability to use the voting power associated with their shares, or simply the fact that they can choose to buy and sell shares depending on how comfortable they are with the direction of the company. That investor also increasingly has shares in a variety of companies rather than just one or a few. Oftentimes, these investors end up owning shares in businesses in direct competition with each other. Therefore, their ideal outcome is not the success of any one business, but the success of their portfolio as a whole. Since any business's behavior has consequences for other businesses' circumstances, it's entirely possible for the behavior of one firm, in its efforts to maximize profits, could potentially have negative effects on the other assets owned by their owners. A very straightforward example of this happened during the COVID vaccine rollout. It might have been more profitable for individual vaccine manufacturers to sell at higher prices than they did, even if it meant less vaccine adoption. And it certainly would have been more profitable for them to be more aggressive when it came to the intellectual property wrapped up in the making of these vaccines, so that other companies couldn't manufacture them. But it was quite clearly better for everything else that their shareholders owned to get as many people vaccinated as possible, whatever price that meant having to set vaccines at, or however weak vaccine intellectual property protections had to be. In this paradigm, acting in ways that are consistent with improving the return of other assets, or at least being perceived as being capable of acting in such a way, incentivizes the holding and purchase of stock. This then pushes stock prices upward. Therefore, through increased financialization, the aim of the publicly traded corporation, under the influence of its shareholders, is increasingly not necessarily the maximization of profit for that particular firm, and this only becomes increasingly the case the larger and more diversified the portfolios of the owners of said corporations are. Consequently, businesses are less and less governed by the logic of maximizing the difference between wages they pay and the prices they sell at, which means that they are growing less engaged in production for exchange as we understand it, which of course applies to the institutional investors themselves that own these corporations. As if they're acting in their own best interests, they are making investment and board voting decisions based on what is effective for their whole portfolio rather than any specific company's profit maximization. This, in my opinion, is the main reason for the rise of environmental, social, and corporate governance goal assessments, or ESGs. It's not corporations being benevolent, or is it merely a marketing gimmick? It is, in my opinion, an attempt to target these externalities. This sort of business behavior then circulates through the rest of the economy. Corporations' dealings with non-publicly traded businesses are colored by this type of decision making. Businesses then end up being founded and operated around contributing to this ecosystem. The economic order I describe here is quite different from the way that people traditionally understand capitalism to be, but it is certainly explicable as to how it is springing up from within capitalism. I would say, in fact, our current economic order is essentially to capitalism what absolutism was to feudalism. The owners of capital remain the primary beneficiaries of the way that we go about organizing our economy, just as the landowning aristocracy were the primary beneficiaries of absolutism. However, there are fundamental shifts occurring behind the curtains that gesture towards a new organization of the economy. As consolidation of legal power around the monarch and rationalization of law allowed for industrialization and the capitalists to rise out of feudalism, our current economic order calls out for planning at all levels to be better carried out with regards to real resources, their usage, and their consequences, rather than just chasing the shadow they cast through the price system. This, of course, requires increased professional expertise, from psychologists who understand people to environmental scientists studying environmental effect. The professionals producing these assessments, for the most part, share their lack of capital with the rest of the working classes, in much the same way that industrialists shared their lack of noble title with the peasantry. The inequality produced by that capital not only denies power to a group that's increasingly important to planning our economic order, but is also an obstacle to durable analysis and planning based on real resources. In much the same way that aristocratic privileges once denied power to commoners and obstructed the organization of the economy around market exchange. All of that is descriptive rather than prescriptive. I believe everything I mentioned so far explains the economy as it currently exists, rather than having spoken much about what I believe we should do in response to this. I also have, in this video, admittedly been sparse on concrete examples of the economy being this way, other than pointing to the situation with the COVID vaccine. But I felt it was more important to outline what I think is going on and why, rather than hammering in on specific proof. That, I believe, is better done on a case-by-case basis with other videos. With that, however, we reach the end of this video. Please like, share, subscribe, and comment.